Debt is one of those things that can make or break a company. Now, if debt is really important, the question becomes what are some key metrics that are going to tell you whether or not a particular company has a good level of debt or a bad level of debt? And one of those metrics is, of course, the interest debt per share. In this video, you will learn everything that you need to know about this particular metric, including how to calculate it, why it's important, and how to use it for your stock analysis. And if you stay until the end of the video, I'm gonna show you how it is that you can get this metric automatically calculated for a list of companies all at once. Okay, so as you can see, the interest debt per share formula is very simple. You take all the debt, so this includes the long-term and the short-term debt, and you add the interest expense to this amount, and then all you gotta do at the end is divide the number that you get right here by the number of shares outstanding of that particular company. So we're gonna calculate this number on a quarterly basis for a company that you know very well probably, and this is Apple. We're gonna get the company's financials using the Y-Sheets add-on on a quarterly basis. The quarterly and annual calculation is exactly the same, but I just want to show you a different type of way of doing it. So here we go. So first things first, we're gonna take the interest expense of the company. This can be found right here on the income statement. So you can see right here how we have the interest expense. So we're gonna take this number, and then what we're gonna do is we are going to take the total debt of the company. This is found on the balance sheet, and as you can see, we see long-term debt, and then we just add the short-term debt. Here we go. Now we have both of those numbers. So now we just have to add both of them together. So we just take this plus this, and this essentially gives us the top of this formula right here. Once we have that, then we just need to divide this number by the number of shares outstanding. So we take this number divided by this, and the interest debt per share in this particular case is going to be equal to roughly 7.18. Now, if we wanted to calculate this on a historical basis for all these other quarters right here, all you would need to do is simply drag this formula across like right here, and then drag the other numbers so that way we get them for the previous quarters. Drag this one right here, and then this one to finish off, and there we go. Now we get this automatically calculated on a historical basis. And if you look right here on the key metrics, just a little fun fact, this number is already calculated for you right here on a historical basis as well. Now in this particular case, what this number means is that for Apple, for every share that the company has, and in this case you can see the number of shares that the company has outstanding for this particular quarter, it means that the company has 7.19 in terms of per share of debt plus interest expense that the company has to pay pretty much every single quarter. Now here is how you use that information and how you use this metric. Generally, what you're looking for is a company that has a low number. And the reason why is because if the company has a low number, the only way that you can achieve that is basically by having less debt. And having less debt means that the company has less risk, that it's not going to be unable to pay off the debt and then have to go bankrupt. So we definitely don't want that to happen. So low debt is generally a good thing. Now, the other side of the argument, and this is why it's important to see a balanced number, is that if the company has no debt at all, then that's not necessarily a good thing, because the company could be using debt right here on the balance sheet to make investments that are going to generate a higher return than the interest that the company has to pay, which you can see right here, and this will generate a higher return for shareholders. So as we learn, the number that you're looking for is a balanced number, but then the question you may ask yourself is, how do you know that you're getting a good balanced number, a number that's not too high or too low? And for that, the best way to do this is to get a list of companies that are in the same sector, same industry. In this case, we have a list of semiconductor stocks, and to compare them across the key metrics that matter most to you. In this case, one of those metrics is going to be the interest debt per share, and we're gonna get this number for the last fiscal year available of data. So using Whitesheets, this is very simple. You're gonna select the list of tickers that you're looking to use. Just make sure to use the Yahoo Finance ticker system. Then you enter the data that you're looking to get, and as you can see right away, we get the interest debt per share for all these different companies. And now we can compare this number and see whether or not for a particular company that number is high or low. So in this case, we can see for Nvidia, the company seems to have a pretty good number. This seems to me the right balance for this type of industry in terms of having a decent amount of debt but not having too much debt where it could be a problem. And we can see that other companies have a similar number. You can see this one right here. You can see this one's a little bit higher. So this is the way in which you can analyze this data and start to make sense of all of these very important key metrics. Now you know how to calculate interest debt per share like a real pro, so be sure to use this information so you can incorporate it in your stock investment analysis and make great investment decisions for yourself and for those people you most care about. If you've enjoyed this video, make sure to subscribe and turn on the notifications on so that way you get notified every time we release a new video like this that's gonna allow you to take your investing game to the next level.